comment comes in. It says, last week you showed that you discussed those review trade ideas with related to calls on the VIX and bull put versus bear call. How do you identify calls on the VIX? Okay. I believe that was from 2 weeks ago, if I'm not mistaken. But regardless of which, what I typically look for buying calls on the volatility index, I'm looking at when it has hit a recent low. I don't think right now is a good time necessarily to be buying calls on the VIX. 19 is low from what we've seen, and probably on the average over the last 2.5, 3 years, from 2020 into what the volatility of 2022. We were seeing constant 24s, 25s, and 26s in 2022. It went as high as what, 38, 40, 48 maybe during 2020. But this is at a relative high right now compared to where it has been. Let's go ahead and take a look at the chart of the VIX of the last few months, maybe even the last year. And so when we were talking about getting into calls on the VIX, it was during this time frame when we were around 13 and 14. And over here too, we talked about it, I believe, a couple months ago. And so we had this dip, and we've had this spike up here. We all know why. And then the recent spikes recently, of course, within the last 5 or 10 days or so, due to various things, of course, going on in Israel, unfortunate incidents in Israel. Also, some concern about what's going on in the house right now, the people's house, we could say, and some uncertainty there, and many other things that are going on. So this is near recent high for the last 3 months. And if we go back over the course of the year, let's just go year to date, shall we? You know, we did hit as high as 28 at the beginning of the year. Was that February? Oh, it was March and April. So with the different rate cut talks and, of course, that's other things that were going on globally, we went into those higher spikes of 28, 29, and we're settling down here. But the bottoms we were seeing that we haven't seen in a while were in that 13 range, 14 range, 15 range. And that's when I start contemplating buying calls on the VIX, because it feels like it wants to be in this range with these spikes that we're seeing. Get a spike, has it come down, gets a spike, has it comes down. Now, in general, when I look for calls on the VIX, it's when I feel we're at sort of a recent doldrum or a recent low. This would have been a bad time too. But I typically tend to just go maybe 45 to 60 days out in time. Sometimes it's 75 days. And I just look for two things, really. I look for a delta of about 0.3 or less, and out of the money calls, purely speculation, but this isn't designed to be speculation for profit. When I use calls on the VIX, it's more of a hedge in the more leveraged bullish positions in my portfolio. It's a hedge if I'm doing bull put credit spreads, calendar calls, or the poor man's covered call, perhaps those positions where if stocks fall 5, 7, or 8%, well, I might be near full loss on the bull put credit spread, or I might be down 25, 30, or 40% on the leveraged poor man's covered call. I want to use these calls on the VIX or puts perhaps on SPY as a hedge for that portion of my portfolio. So I might only be using this with maybe 2 to 4% or so, maybe 5% at most of my total portfolio, just as an external hedge for the unexpected. When things are in the doldrums, when things are in the low. When we have these spikes like we had up to here, now the implied volatility of the volatility index options are too high and it might be too expensive. I said two things. What's the second thing I look for? I usually look for a premium of less than $1 with a delta of 0.3 and a premium maybe around $1 or so, 80 cents to maybe $1.20, somewhere in that range, I should say, is typically what I look for. I already know how much I'm going to allocate, so that the cost of the option isn't that relative. It just dictates, hey, am I buying 8 contracts? Am I buying 18? You know, am I only buying 5 because it's actually priced at whatever price, $1 or $2 or $3 with a 0.3 delta? But that probably tells me if it's that high of a price at $2 or $3, that the implied volatility is too high, and I might suffer from an IV crush on the volatility index options. Now, I think I even have a search set up here. I don't know if it's in this particular account, but let's go ahead and take a look in the search field. Oh, I'm sorry. Let me go to sample searches first. I don't think I put it here. No, I didn't put it in the sample searches. But I think months ago, or maybe even more than that, I thought we created a VIX search. High V, low IV, my long calls, no static. Nope. Okay, I guess it's not on this one. It must be on that other account. I do apologize. So what would I look for in my VIX calls? It's really simple. So as I mentioned, I'm going to be somewhere between maybe, let's say 40, I'm going to say just 40 to 80 days out in time. And as I mentioned, I'm going to look for a delta of less than 0.3. And I'm going to look for maybe an option midpoint price of, let's say, less than $1.35. Now, I'd like it to be $1.20, but I know the volatility, the implied volatility is higher right now. And that's pretty much it. Yeah, I'm going to put in some basic open interest, but by the way, that's not a problem with the VIX options. Now I'm just going to go to the lists. I just put in the basic stock criteria, or the basic option criteria, my apologies that I had. And where is it? I could have sworn I just had the VIX list here. Oh, maybe I didn't go alphabetical order. Huh, okay. Well, let's just create that. My apologies. I mean, it is just on my personal. We did it on my personal account in one webinar. We didn't do it here. Oh, wait. I'm sorry. Before I do that. Nope. I thought, I'm sorry, maybe we created a volatility one. I could have sworn we created a volatility one at one point. But I am going to call this volatility. If I can spell. There we go. I'm just going to put in 3. I am going to put in the VIX because it moves the best, but I'm also going to put in VXX and UVXY. Let's go ahead and create that. All right, now that I've created that list, volatility securities got 3 in there. That's great. Let's go ahead and close the window. It's going to refresh the page for me to load that in. It's kept my option criteria. Now we can go to lists. And from the list, I'm just going to include my stock list of volatility securities. All right, let's go ahead and submit that. All right, so here are the VIX calls. There's some out to December. So the VIX is at 1932. The December 28 has a delta of 0.29 and a premium of 130. I'd probably be going close. Let's see what's closer in time. Even though I put it out there, I don't want to go that far. Sometimes, as I mentioned, if the volatility is too high, I feel like I want to go 75 days out. Let's keep it under 60. So about 50 days out in time, be 42. Yeah, that's about right. Okay. So 68 is not that bad, actually. But the 42 days out here, delta's a 0.2, 0.3. But look at the prices. Look at how high we are in the strikes. Now remember, oh, this is VXX and UVXY. I'm sorry. That's why they're so high, because the higher strikes, 37, 38, 39, these are different prices. VIX didn't even appear in that shorter term. We'd have to, I apologize, we have to go out to December in order to see a 0.3 delta with the premiums I want. But they're still pretty high, aren't they? Some of them are almost double, 38 with the VIX at 1932. The lowest is the 28, the price of 130. That's okay, because if it goes up, we're going to see a profit. But look at the implied volatility, 1.068. Let's just focus on this December 28 strike with the VIX trading at 1932, $1.30 midpoint, the delta of 0.29, right in the wheelhouse of what I want to look for. But the IV over this, it's overvalued right now, and the IV over the SIV is overvalued too, and we're at 1.068. Why is that important? Let's go now to the option research tool, which I accidentally clicked earlier in our discussion. This may take a minute. The reason why it takes longer at this time during the webinars is because we're loading all of the historical data into the tables. And this field uses the historical data to show us the implied volatility range. And actually, it's not as bad as I had anticipated. What I'm looking at here, I want to see the implied volatility range And the implied volatility range of this particular option, since it's been released on the market, is 0.7819 to 5.677, or so you might say 78% to 567%. So right now it's only 6% of its total IV range since the option was released on the market in April of 2023. There's that big spike there. July 24th of 2023. There's the one on 8/22, another big spike in the implied volatility of this particular option. So it's actually relatively low, but compared to shorter term, I'm just using the scrubber here to see the historical implied volatility. It's actually not that bad, but it's still relatively high. Now, I'm not saying this is the one I choose. I'm not saying this is the one I would do. It seems pretty high for me. Actually, I think what I'm going to focus on probably, if I was buying protection right now, I'm probably buying puts on SPY rather than using the VIX calls. But let's go to the back test very quickly. No, I'm sorry. Let's go back to the search. I'm really sorry about that, folks. Let's save this correctly. And now we're going to go ahead and call this our VIX and Volatility Hedge long calls. Fantastic. Now let's go in the back test. Let's go to the Smart History. Let's go back about 3 to 4 weeks in time. So we'll go back to, I want to say, yeah, let's go to the 18th, following standard expiration. So just about 4 weeks back in time, 3 weeks, 4 weeks back in time. Let's see which VIX or volatility hedges would have matched that search we just created, just looking at VIX calls, UVXY, and VXX, options with less than a 0.3 delta, call options with less than a 0.3 delta, and with that option bid price, of course, under, I think we put $1.35. All right, so we've got a bunch of the VIX calls dominating the first results. We're showing 30 of the top 90 results on that group. 40 to 75 days out, so we're looking at the Novembers, which are 58 days out in time. Ignoring these ones here with the 0.01 delta and no bid. I should always change that. That's one thing I did mean to do. An option volume of today of greater than 0, or putting a bid-ask spread to a minimal range. But let's just clear that up a little bit. Okay, there we go. Some of these are still way far out of the money, but this is when the VIX was at 14. Let's narrow this down to closer out of the money range, so we're not going more than, say, 20% or 15% out of the money, just to get a narrowed down list. Oops. I think I wanted less than 60. I wanted less than 60. I'm sorry. In my head, I reversed that. There we go. Fantastic. So good VIX call was the 22. Delta of 0.27. That's probably the one I would have chosen, the one closest to 0.3, with the midpoint price nearest to $1, 58 days away. We do see the VXX and UVXY, but this would be the most likely candidate closest to the stock price with the midpoint ask price I wanted under $1, $1.35, with a delta of closest to 0.3. Now let's calculate group results. So that VIX call right now is at a 76.6% return with the VIX at 1932. UVXY was at 1348 with the November 21. Now it's at 1811, so we've got 152% return. And the VXXs, you're seeing a higher return. And you say, oh, why wouldn't you always do those? They don't always react this well to what's going on in the market. But this is just a static return today on 10/13, roughly, as I mentioned, 4 weeks later from our search on September 18th. But I want to analyze the position. This might take a little bit longer, as I mentioned, due to the fact of everything that's going on in the background, that we're uploading all of the historical data, and it's interacting with the tables. But here's the historical range on, of course, September 26th. Remember, we would have entered this on the 18th. On September 26th, the max return was 163. Okay, so probably, and let's just look at that from 9/26 to today. Let's see here, 9/25, 9/26. Okay, so there's the spike in the return at 9/26. and there's another spike here when it was about 100% return. So we're comparing SPX, but down below we can see the return, the option midpoint versus the stock price. There on a 926, that's the peak. And there's another good return there. It leveled out here, and there's another good return here. And at the end of the day, we're still about 76%. So why am I showing this? Because a secondary approach, and I think we have a webinar that discusses this a little bit more, about the same, but it goes a little bit more when you asked about the VIX calls. There's the search that I would generally use. It's not the best search. It's just the one I like to use for the hedge. But as we can see, in my opinion, I think the prices are too high, and the volatility, and the implied volatility, I should say, the volatility ETF might be a little high. For a market hedge or hedge for those bullish strategies, which I'm not really in many right now, I might be using puts on the SPY because it's not as inflated. But general approach, what I would typically do, we open this on the 18th. And, sort of break even here in the first few days. Hey, I'm up to about a 27% return, a little bit of movement in the VIX. But here on this spike, when I get a spike like this, let's say that I had bought 8 contracts at that time. So when I see this first spike, I'm probably selling half. So I'm going to sell 4 of those contracts and have 4 remaining. Remember, this is out to November expiration, so I have time. But you see how quickly you have to catch the spikes. This isn't just, oh, let me put on this hedge and see what happens. In worst case scenario, I'll just get out of everything. Hey, that's valid too. And then when you see a dip back down, maybe buy back into it. Oh, here's a little one and close it. My approach, and like I said, I don't know if it's the best approach, but it's just a guideline. I get that first spike after I bought those calls on the VIX, I'm going to sell half of them. I see the second spike, I'm going to sell another half. So I'm going to have 2 contracts remaining. Maybe here, or if the VIX next week reaches 20 and I'm back up to that 97 or 100% return on the position, this could be a spike that I might have missed. But I was sold another half. I might have sold that other half today possibly because we were just about to losing money on the remaining 2 contracts. So might have sold half today on the spike as well, down to 1 contract remaining, taking the profits as we move. But hey, also might have been a buy point here when the VIX had dropped back down. Let's see what the price was there at that bottom on the other graph down below. So the position of our total, yeah, we're down here. The VIX was at 16, near buy point again, right? Kind of near that buy point again, where we went up to, I apologize, we went up to 19.5. Here at the big spike was 18.5, 19.5, pulling back down to 16. Recent low, but yeah, usually around 14 or 13, I'd trigger that buy. That's the blue one. It hadn't hit that back again. But maybe I am at another sell point here and would only have 1 contract. I mean, that's the general approach. The criteria we talked about, 40 to 75 days at a time. Don't go more than 50 to 60% of the money, but look for the one closest to the stock price, closest to the VIX price at that time with that delta of less than 0.3, but closest to 0.3 in my opinion. Want some open interest in volume. Then, when you see the spike and you have maybe a 90, let me do it on this one, you have maybe a 90, 100% return, 110% return, sell half or so. And then when you get the next spike, sell another half because you've got the time. But if you see a time to buy back in, the VIX drops back to that $13 or $14 level where you bought into the position. Look at it that time, of course, to see maybe a possibility to buy depending on what's going on in the market, or just hold on to the remaining ones that you still have. Now, another question comes in. Follow-up came in during this discussion is, yeah, but is it profit? It doesn't say yeah, but is it profitable long term? Well, I'm not doing this on a consistent basis. I'm doing this when we get to a lull, and especially if the VIX is down in those 14 or 13 lows. That's the new target now. Remember years ago when the VIX stayed for months at the $9 and $10 mark? Volatility was really low. Covered calls were harder to find that good premium that you wanted. Yeah, the weekly options especially were very difficult to find a good premium above 20 cents or 15 cents, even on 30, 40, or $50, $80 stocks, even because the volatility was so low. It was back in 2021, I think, but before that, it was way back in 2017, I think was last we looked, where it was just an 8-10 month extended period of the VIX just being at around an average of 10. Sometimes it was as low as 9. Sometimes it peaked up at 11. Ooh, excitement, we're getting some volatility. Then back down to 9. So that isn't a time when I'd be using this. It's using it for the unexpected. We just seem in the last 4 or 5 years or so to have had a lot of unexpecteds pop out of nowhere. 2018, the saved this VIX call idea I'd been doing for about 6 to 7 months. And February 5th through 9th of 2018, I had 3 bull puts open and I had 8 contracts on VIX calls open. And in a first sudden move on about February 5th, all 3 bull put credit spreads I had in my portfolio at the time hit a 50% loss. I was representing about 15% of my total portfolio. I closed them all that day at 50% loss. Part of my, trading plan for that strategy in my portfolio. And I sold half of the VIX calls. The next day, the bull puts were down 65% of the maximum loss. The next day, they were down at 80. And the following day on the 9th, which was expiration, they were all down 100%. That week, I had 8. I sold half. A day later, I sold another half. Waited 2 days, sold another half of the VIX calls. The gain I made on those VIX calls countered the losses I took on the bull put credit spreads. That was an extreme situation that happened with a spike in volatility and a market pullback, all due to someone commenting out in the world that thought a trade roll with China would be a great idea. And the markets did not like that discussion. And they showed it. And so the markets went down, the volatility went up. But in a time period, let's say of 2000, this worked in 2020 for me with all the volatility spikes that were going on. This worked in 2022. This worked recently when we saw the volatility dip down. And I said, hey, you know what? If you're concerned about the market, you're concerned about things that you're hearing, look at where the VIX is. It might not be a bad idea to buy calls on the VIX. And we did some of that with that approach. That's where that webinar that you saw in the beginning discussion, we reviewed the webinar content. Now, but in a market, let's just go here real quick to SPY. And we're just going to go to big charts. I'm just going to look at some various years real quick. I'm not looking at the VIX. We're just looking at SPY. And I'm going to use the custom view. So, of course, as we mentioned, 2018. Let's go to January to 2018 to roughly, let's just go to April 4/15/2018. Beware the Ides of April. I know that's not the one. I was just using that. But there you see it. Look at that. That's February 5th through 9th. That's what killed the 3 bull put credit spreads in my portfolio on SPY. We dropped from hovering around 280 down to 254. Now, it's only 30 points, but in a 5-day period, that's more than a 10% movement. It was brutal. It hurt. But the VIX calls did exceptionally well. Let me see in this time frame if it lets me compare the two. Let me erase the drawings, of course. So that's that 2018 time period. So I do compare it to an index. Oh, they don't allow me to do the VIX, and I can't put what? Maybe I can. But I think they use a caret. Let me just try that. Okay, so it just shows the gain, but during that same time period, you can see the VIX went up roughly about 270%. We might just have to look at it as its own instead of the comparison there to the SPY. It's harder to read the chart that way, but that was that movement. And let's just change this to, what happened in 2021, but let's go back, 2020. Let's go back to essentially all the year of 2021 to 12/30/2021. There were a couple downward movements in here, but you know what they weren't? They weren't sudden. There was one big one there towards the end of the year. You can see that it went from 470 down to 450. About a 5% movement downward. This year, 2021, is what I like to refer to as a melt up. We've got good gain, okay, a little pullback. Good gain, little hesitation. Good gain, little hesitation. Good gain, little hesitation. Although there are times when you see these quick spikes, VIX didn't react that hard because a lot of the downturns, there were a couple ones you see, but they weren't major. going from 445 down to 435 in a few days. And stomach that. It's noise, roughly. It stinks, but it's noise. But then, of course, again, you see these kind of situations here. But why doesn't my VIX approach work with this? Because it's not the sudden downward and unexpected. It's a gradual decline. Here's a little spike, a little comeback, and then a little pullback, and then back up to the melt up. This one was the one where it would have worked. The rest of the time, the VIX calls did lose money, this approach. I looked at it using those backtest tools we just saw. And it hedged against the market downturns a couple times, but in general, it was just wasting money because it wasn't doing it. It wasn't the type of volatile market that we've seen somewhat this year, and it's not really even that volatile to an extent. But compared against, remember 2022, I know we've all tried to forget, but remember 2022, the uncertainty we saw in 2022? This is where the at-the-money bear put debit spreads and the VIX calls came in really handy as market hedge. A lot of this was, of course, the war in Ukraine, but a lot of it was just comments made by Powell, the interest rate hikes. And some of the amazing things about these is they would come out and he'd say, oh, we have to do this with the interest rates to fight inflation. And when he announced it, the market would move up. But then when he actually did it, the market moved down. Well, he said what he was going to do. It was very odd that when it was actually, and sometimes it was reversed. He said what he was going to do and the market dipped, and then they went ahead and did it, and the market went up that day. It was very confusing. But the VIX calls with these swings that we were seeing, with a lot of world events, but a lot of the interest rate hikes and a lot of things Powell was saying and other content, that's what was causing these swings. And this is more of a market, and as we saw, that 2018 portion was the time to use it. Volatile, uncertain, fluctuating markets. Melt-up markets such as 2021, it didn't work, right? It's used different for different market conditions. And we saw for 2023, of course, let's go back to just year to date in this. For this one, we've seen a couple of movements, and this is SPY, not the VIX, but you see here's a couple big drop downs. Here's a big 4 or 5 day drop down where it would have worked. This would have all lost money. Maybe made some back here with the VIX calls. This would have been making money. This is almost too long of a downtrend, but probably did see it. This one here was sharp. That recent one was sharp in both times. Guys, am I in the right year? Yeah, I'm in the right year, aren't I? It just seems a little bit much. Yeah, we're in 2000. I apologize, folks. We're in 2023. That's what we're looking at here. So that again, see some settling here. The VIX, as I mentioned, is pulled back down, but it's still up at 19, and outside forces pushing in on that. And so that's what we're kind of concerned with. This is a market condition that saw time periods where we're at 2022 was really strong with volatile movements, and these volatility hedges worked. But again, when I come out of the volatility hedge, when I've been selling the half, and selling the half, now I'm down to only 2 contracts or 1 contract. I'm probably getting close to the expiration date in these more pronounced volatility moves. So I may just have to sell to close the remaining part for a loss. And at that time, if the volatility is still high, but I'm getting close to expiration, as we saw the VIX at 19 now, it's at a relative high. Sure, it could go up to 22, 23. It could see more movement where what we were looking at is 24 calls out to November might be profitable, or 22 calls. But again, might be better hedged to use the puts on SPY. Ernie actually does have something else. I wouldn't recommend it this time because I think the market's still too volatile with things going on. Uncertainty in the speakership of the House, uncertainty, of course, in unfortunate actions in Israel, and still what's going on in Ukraine, of course. Too much uncertainty out there that, hey, we don't know what they're going to do with the interest rate. We have an idea, but we're not sure what they're going to do with the next reports that come out. But again, maybe puts on SPY more in the game right now, more on the menu for today, perhaps going forward, as opposed to calls on the VIX until we see a little bit more pullback. And again, this was from September 18th. The current prices we saw, just the standard search for our long calls that we created. VIX at 1932 there. And the volatilities are pretty, but not as high as I thought they were comparatively. pretty much around the average since these have been released, but these are the December and November series we initially started to look at. Where I was going with that is for peak times and at times in those melt-up markets we discussed, such as 2021. Ernie, I believe, did create a sample search, if I'm not mistaken. It might be in the main search, but I thought it was in the sample search. Yeah, VIX weekly bear call credits. But in those cases, the VIX has to be trading below its 20-day moving average with a negative MACD crossover. We're not seeing any results because it's not below its 20-day moving average, and none of the volatility indexes similar to the one that I created that we just saw have a negative MACD signal under at least one. They're all positive because of recent movements in the market. But when we're in that melt-up market, when that stronger bullish market, sometimes this bear call credit spread on VIX or other volatility, VIX, VXX, and other ETFs is not a bad idea. But it takes the chance, because when the unexpected happens, what happens? The VIX suddenly spikes up, a black swan event. That bear call is going to be wiped out. But it should be the very, very small portion of your portfolio, just like the buying calls on the VIX, because you're using it more of a broad hedge, not to be your main instrument of profit in your portfolio because of wild swings and unexpected events that can occur. That's great for the long call portion, bad for the bear calls if we've been in a steady market on the volatility ETFs. All right, so that's just a summary there of basically what we look at. Let's take a look over here at our YouTube channel. Real quick, let's see. Yeah, that was 5 days ago. Buying calls on the VIX, ATM, bear put, debit spreads when we started to see the sell warnings on the market sentiment tool and power options. But let me just use the search function here. I just want to look up. That was from 2 months ago. It's 21 minutes long, so a little bit longer than this discussion. Covered calls or collars on the VIX. That's the one from 5 days ago. Yeah, so that first one, trading UVXY or VIX for portfolio insurance. This one is more in depth, and it was about 2 years ago exactly. How can I know it's about 2 years exactly? Just based on the background I'm using here, a little bit of Halloween and some of the decorations we had up in the house. We haven't decorated yet, of course, for Halloween because it's supposed to rain this weekend, so we're waiting until after that to decorate. But this was probably around 2 years ago, around October 20th or to October 25th, somewhere in that time frame. We had our Halloween slide deck for our open forum Q&A discussion there. But there's just some ideas, some other ideas there. A discussion on VIX calls is a good one. And, of course, this one here, trading UVXY or VIX for portfolio insurance, going a little bit more in depth